Hello and welcome to this session. This is Professor Farhat. In this session, we're going to look at how account receivable is presented and how do we analyze account receivable for decision-making purposes. Presentation, account receivable would affect the balance sheet, of course, directly, and will affect the income statement indirectly through bad debt expense, through sales, so on and so forth. So what do we need to present on the balance sheet? Well, the first thing we need to do is we need to identify the balance sheet, identify in the balance sheet or in the notes the major types of receivable. What are the major type of receivable? If you remember at the beginning of this chapter, we said we could have trade, non-trade, we could have notes receivable, and we could have other receivable. So we have to break our receivable into various components, and we'll look at an example shortly. Report short-term receivable as current assets, and most account receivable are short-term, therefore they are reported as current asset. Report both the gross amount of the receivable as well as the allowance. So we show the gross amount of the receivable. For example, if it's $1,000 is the gross amount, and if the allowance is $25, we show both. The 1,000 minus the 25, which will give us 975. And remember, that's called the cash realizable value or the net realizable value. Those are three main things. On the income statement, we report bad debt expense and service charge expense as a selling expense. Because again, why it's a selling expense? Because a receivable is a result of your sale. Therefore, if you have any bad debt expense, it's part of your selling effort. Therefore, it's a selling expense. As well as when you sell a receivable, your factor will charge you a fee. That's also part of your selling process. Report interest revenue. If you have any interest revenue under other revenue and gains, if you have any interest revenue from your receivable, you would report it under other revenues and gains. And this is an example for a company. For example, here receivable, we have receivable from unconsolidated subsidiaries, trade receivable and notes receivable separately, financing receivable, restricted financing receivable, and other receivable. So we have the different categories. We have total receivable, gross, minus the allowance. And this is what I'm talking about gross minus allowance. And this is for Deere and company. Okay, this is just an example from the real world to show you how how does a balance sheet present receivable. And we show here net receivable. Again, net receivable, this is the NRV, or this is the cash realizable value. How much cash do we expect to receive from our receivable? Analysis, when we look at account receivable, one ratio we look at is called account receivable turnover, and it tells us how many times our receivable turnover. Simply put, if we're looking at 1 year, show you a picture of it, how many times do we sell, collect, sell, collect, sell, collect, sell, collect, sell, and collect? For example, here 1, 2, 3, 4, 5, 6, 7, 8, 9. For example, here we turn over our receivable 9 times. How do you compute this? Well, the way we compute it is we take credit sales or net credit sales, divide them by the average account receivable. And the reason we use the average is because our sales are happening throughout the year. So we want to make sure we'll take the beginning of the year and the end of the year receivable, divide them by 2 to get an accurate picture of what's happening. Okay, so let's take a look at this example. In 2015, Cisco System had net sales of $37.75 million. Its beginning receivable is $5.15 million, and its ending is $5.344 million. Assume that Cisco sales were all on credit. Okay, that's fine. So we can compute this. So we'll take net sales on credit, divide them by the average receivable. Again, what's the average receivable? It's the beginning of the year plus the end of the year, divide them by 2. Or this year plus last year, divide them by 2. Okay, so receivable turnover for Cisco is 7.2 times. Let me show you this on a timeline. Let me try to see if I can draw this. Say 1, 2, 3, 4, 5, 6, 7. Let me see if that's the case. 1, 2, 3, 4, 5, 6, 7. 7 point, I'm just going to make it 7 times. So they sell, then they collect their money, sell, collect their money. On average, they collect the receivable 7.2 times. Now, to give us a more accurate picture, not more accurate, a simpler picture of how account receivable work, we could compute something called average collection period in days. So we computed the 7.2, but that doesn't make it makes sense, but it's not an intuitive figure. How else can we look at this figure? We can compute the average collection period. And how do we compute this? We'll take 365, the number of days in a year, divide them by 7.2, the account receivable turnover, and we'll find out that the answer is 51, and it's 51 days. What does that mean? If we go back to this picture, every 51 days, every 51 days, on average, we collect our money. Every 51 days, on average, we collect the money from our customers. Now, some customers may pay earlier, some customers may pay later, but on average, this is how it takes us. A little bit less than 2 months, okay? So let's take a look at this example. In 2019, Phil Mickelson had credit sales of $923,795. It has a beginning receivable of $38,000 and an ending 35, almost 36. Compute the account receivable turnover. Well, if we'll take the figures and we compute them, the account receivable turnover is 24 times. Wow, that's way, way better than Cisco. Cisco is 7.2. Now, every time you compute a ratio, remember, ratios don't make any sense unless you compare the ratio to something else. Now, if Mickelson and Cisco are competitive companies, obviously Mickelson is doing a better job because they're collecting the receivable way, way faster. To be more specific, in terms of days, if we'll take 365 divided by 24.9, which is the account receivable turnover, Phil collect their receivable every 15 days. So every 2 weeks, they collect the receivable, they sell again every 2 weeks. So they should have more cash on hand, obviously, than Cisco because they're getting their money much, much faster, much faster. So hopefully this will give you an idea how do we analyze account receivable. If you have any questions, any comments, by all means, email me or see me in class. As always, if you're studying for your CPA exam, study hard, it's worth it.